This will be kind of finishing up our discussion on budgeting that we did last week. It's relatively short. Remember, we talked about the master budget and we talked about flexible budgeting. And in Chapter 7, we talked about flexible budgeting for direct costs. Here we'll talk about it for overhead costs. Pretty much in every section there's one or two key points. The key point to take out of this section is when you look at variances related to indirect costs, you need to treat them with care. When you have variances related to direct costs, you should be able to identify the causes, work your way down, say, oh, we paid too much, or we have problems with our machinery, and take corrective action. With indirect costs, since they're being allocated based upon some other allocation basis, let's say direct labor hours, you could have a problem with your direct labor hours that's resulting in a problem with the variance on your overhead for your overhead costs. So the problem is not in the way you're managing your overhead, it's the way you're managing your direct labor, since that was your basis. And that's the key takeaway from this unit. But let's go through it. We'll distinguish between product costing for accounting purposes and